So we're looking at the September-December 2020 paper. Okay, we go straight to the requirements part. We look at the requirement first. Okay, part A, evaluate the matter to be considered. Okay, this is part A. Then there is a part B. Okay, we can then quickly do okay. Let's go through this part. Okay, now evaluate matter that should be discussed with management in relation to each and recommend further action prior. So we're going to break the answer down to two parts, what to discuss and also further actions. And we read through the question first. Okay, Sunningdale is an online furniture manufacturer and retailer. Financial statement recognize 6.5 million, PBT 1.2 million, total asset 18 million. Materiality has been set at 40,000. Okay, that's already set materiality. Now, Sunningdale has a profit target to meet as part of the covenants on their bank loan financing, which is for profit before tax to increase by 6% on prior year levels. Bank loan would not be repayable immediately in the event of a breach. Okay, well, this does look a bit odd. Okay, let's look at this part. So here, as a covenant bank loan, which is for profit before tax to increase 6% from prior year level, bank loan would not be repayable immediately in the event of breach, but Sunningdale will have 2 years to rectify the breach and has not breached any financial covenant since taking on the loan. Okay, they seem to have a biasness involved. Okay, there's a management bias. Now, working capital paper contains the following uncorrected misstatement. Investment property, there's 25,000. Okay, that one looks like under the materiality level because it's 40,000. Special manufacturing equipment, 140,000, 140, that's material. Gift of car, there's no number here. Okay, here, during the year, Sunningdale adopted fair value model for its investment property for the first time. Fair value model for investment property for the first time, and valuation was carried out. Valuation showed that all but one investment property had a value above their carrying amount. Exception was investment property which has a value of 25,000 below its carrying amount. The directors are refusing to adopt fair value model for this investment property but have accounted for the revaluation gain of the three others. So here there seems to be a accounting treatment error. So all you have to do is tell how to handle this treatment error and is there a problem with this treatment. Okay, let's look at the first part. Since there are three parts, we'll talk about the first one. Misstatement is not material since 25,000 is less than 40,000. Okay, the misstatement is a factual misstatement because management must adopt consistent policy for investment property. In this case, they adopted fair value. There is no cherry picking allowed. All investment property need to be reported using the same basis. The changes in fair value is reported in P&L. No basis for changing back to cost model if there is lower valuation. In fact, the management behavior This may be due to the covenant pressure. Okay, that's the covenant pressure. If the adjustment is not made, investment property not been revalued will cause asset and profit to be overstated. This behavior an indication of lack of management integrity, which could apply to other areas of accounting. Okay, that's the investment property part. Okay, let's go to the next one. In addition to revaluing investment property, management has decided to increase its useful life of specialist manufacturing equipment by 5 years, as finance director believes it more accurately reflect value of equipment over life. Financial controller has recalculated the carrying amount of the depreciation from the date which specialist asset was capitalized for journal in 20x5 financial statement. Entire difference in cumulative depreciation starting from date of original purchase. The change in useful life resulted in journal debating accumulated depreciation for 180 million with 140 million, and is recognized in P&L. Okay, it's a lot of errors here. Let's go through this. The statement is change in management has not provided any valid reasons for the change in accounting estimate should be prospectively adjusted and not retrospectively adjusted. That's what the financial controller did. Retrospective adjustments are made to retain earnings directly and not to current year profits. This is also wrong treatment. Okay. Um, Therefore, changing depreciation impact on profit to management lead to auditor questioning the integrity this changes. Okay, that basically cover that part. Okay, um, let's move on to the last one. Gift of car made to members of director's family. So as part of review of depreciation policy, it's found that Sunningdale gifted two company cars to son and daughter of one of the company's director, David Fisher. David Fisher's son and daughter are not currently and never been employed by Sunningdale, and no payment was requested or received. Carrying amount of the motor vehicle was 35,000, and transaction was correctly accounted as a loss on disposal, being recognized 35,000. No disclosure has been made. All related. Need to get authorization of the transaction. appear to be normal business. Disclosure is needed. Okay, then we come to one action now. So what are the further actions that you need to do? Now the further actions that you have to do include right. Next one. Make corrections. Intend to the method do starts with governance. Audit report. Okay, that might be the procedures you're supposed to do. Enough. Now once you're done with that, the next part B, 1 September, auditor report, financial report year, and is due to be issued in next 2 days. You are considering the form and content of audit report. The following discussion with management confirming the appropriate adjustments have been made to financial statement. You are satisfied investment property is now accounted correctly. However, management indicate they are not willing to make further adjustment in relation to remaining 2 issues. So, remaining 2 issues, assuming management does not make adjustment, justify appropriate audit opinion. So here, if they're not adjusting the 2 issues out, how would you report this issue in your audit report? So to report the audit report part, you do need to think about how this is going to be shown. Remember how this is going to be shown in terms of effort. Okay, let's look at the impact in the audit report side. Okay, let's look at the first part. 2 misstatements are not corrected. Now, you do need to consider non-complying with the requirements of IFRS. But not pervasive, since the total for the company is 6.5 million revenue, PBT 1.2 million, asset 18 million. Okay, so therefore a qualified opinion due to should be provided. For the qualified opinion, except for. So normally you give an except for report. Okay, that should cover this one.